Let me ask you something. Have you ever invested money and then spent the next few days constantly checking the chart? Heart beating faster every time the price went down? Or maybe you bought a stock because everyone was talking about it, and then suddenly it crashed, and you had no idea what to do next. If that sounds familiar, trust me, you're not alone. Most people don't lose money in the stock market because they're unlucky. They lose money because they make very normal beginner mistakes. Mistakes I've made. Mistakes you've probably made. And mistakes almost every new investor makes at some point. Welcome back to Knowledge Grid, where we talk about investing in finance without hype, without confusion, and without fake promises. In today's video, I want to walk you through the biggest mistakes new investors make, why they happen, and more importantly, how you can avoid them and invest smarter. So if you're new to investing, or even if you've already lost some money, this video is going to help you a lot. Let's start with the first mistake: investing without a clear goal. This is where most people go wrong, right at the beginning. A lot of new investors start investing without actually knowing why they're investing. They're not thinking, am I doing this for the long term? Is this for retirement? Is this for monthly income? Instead, it's more like, everyone is investing. I should too. My friend made money. The market is going up. And that's it. The problem is, investing without a goal is dangerous. Because when the market goes down, and it will, you suddenly start questioning everything. You don't know whether to hold, whether to sell, or whether you made a mistake. And that's when panic starts. The simple fix here is this. Before you invest even $1, ask yourself, what is my goal? Is it long-term wealth? Is it retirement? Is it passive income? Once you have clarity, investing becomes much less stressful. Chasing hype and trending stocks. Alright, let's talk about a mistake that destroys a lot of beginner portfolios. Chasing hype. You see a stock everywhere. YouTube videos, Twitter posts, Telegram groups, news headlines. Everyone is saying the same thing. This stock is going to explode. Don't miss this opportunity. So you feel pressure. You feel like if you don't buy right now, you'll miss out forever. So you buy. And then, the stock drops. Suddenly, nobody is talking about it anymore. And you're sitting there, confused and stressed. This happens because most beginners buy excitement, not value. Usually, by the time a stock becomes super popular, the smart money has already made profit. The solution is simple, but not easy. Never ask, is everyone talking about this stock? Instead ask, does this company actually deserve my money? If hype disappears tomorrow, would you still feel confident owning that stock? If the answer is no, that's your warning sign. Investing without proper research. Let's be honest, a lot of people invest based on tips, signals, guaranteed calls, random messages in groups. That's not investing. That's gambling. When you invest in something you don't understand, you panic much faster when the price moves against you. You don't know why the stock is falling, whether it's temporary or whether something is seriously wrong. That uncertainty creates fear. The good news? You don't need to be an expert. Just understand the basics. What does the company do? Is it making money? Is the industry growing? When you understand what you own, you're much calmer during ups and downs. Trying to time the market. A lot of beginners think, I'll wait for the perfect time. I'll buy at the bottom. Let me be very clear. Even professional investors can't do this consistently. The market doesn't send notifications saying, hey, this is the bottom. Most of the time while you're waiting, the market keeps moving without you. Instead of trying to be perfect, focus on being consistent. Long-term investing works not because people predict perfectly, but because they stay invested. Putting all your money into one stock. This one usually comes from confidence or overconfidence. You find a company you really like. You believe in its future. So you put all your money into it. That feels smart. Until something goes wrong. One bad earnings report. One regulation change. One industry problem. And suddenly your entire portfolio is down. Diversification isn't about limiting profits. It's about surviving mistakes. Spread your money across multiple companies, different sectors, or even index funds. That way, one bad decision doesn't destroy everything. Panic selling during market drops. This is where emotions take control. The market drops. Your portfolio turns red. You start checking prices every hour. And fear kicks in. So you sell, just to stop the loss. But here's the painful part. Most people sell right before the recovery. Market drops are normal. They're uncomfortable, but normal. If you invested for the long term, short-term drops shouldn't scare you out of your plan. A simple rule. If nothing has changed about the company, Why should a temporary price drop change your decision? Expecting fast and easy money. Social media has completely distorted expectations. You see, turn $100 into $10,000. Earn passive income fast. Guaranteed returns. But real investing doesn't work like that. Wealth is built slowly, quietly, with patience. If you expect fast results, you'll take unnecessary risks and usually lose money. The investors who win long-term are the ones who stay consistent, not desperate. Overtrading and doing too much. Many beginners think, if I trade more, I'll earn more. In reality, more trades mean more mistakes, more stress, more emotional decisions. Sometimes the best move is to do nothing. Buy good investments. Hold them. Let time do the work. Stopping learning too early. The market keeps changing. New technologies appear. New risks emerge. If you stop learning, you slowly fall behind. The best investors are curious. They learn from mistakes. They adapt. That's exactly why Knowledge Grid exists. To help you keep learning and improving. Final thoughts. Here's the truth. Every investor makes mistakes. The goal is not to avoid mistakes completely. The goal is to avoid repeating the same ones. If you can control your emotions, your expectations, and your discipline, you're already ahead of most people. Investing isn't about being lucky. It's about being patient and consistent. If this video helped you even a little bit, make sure to like it. It really helps the channel. Comment below and tell me, which mistake did you relate to the most? And if you want more simple, honest investing content, subscribe to Knowledge Grid and turn on notifications. Thanks for watching, and I'll see you in the next one.